Hi everyone, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation we are doing hypothetical computer simulated trades. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, and myself and my team are here to help you win in life and in the markets as well. Today, I'm here to guide you into the realm of high probability income trading. Now, in a moment, we're going to go over the winning trade, but before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in the position to make money through the passage of time rather than depending solely on price movement, meaning we can often make money whether the price goes up, down, or sideways. Now that doesn't mean we're going to win all the time, but it does mean we have a much higher probability of winning than we might otherwise. Now when you find yourself wanting more information, simply contact us at lockeinyoursuccess.com, L-O-C-K-E, inyoursuccess.com, or leave a comment in the video below and we can get those questions answered for you. All right, let's move on. The winning trade we're looking at today is called a V32. This is a shorter term broken wing butterfly style strategy that we trade on the Russell 2000 and we regularly track on our options trading for income webinars that we have on Monday mornings for our members. The V32 is a fairly simple income strategy that's easy to manage and can be traded with as little as $3,500. Now, the trade entry date on this tends to vary depending on when the previous trade was entered or exited, but for the purposes of demonstration, we're always going to start our V32s 30 days to expiration. The position is going to have an exit loss trigger of $250 per butterfly, which would be 7.1% of what we call planned capital in the trade. As far as a win rate, historically, this trading strategy has won approximately 80% of the time it was utilized. The position has no profit target, but the average win when the strategy wins runs about 5.5% of our planned capital per month, with larger monthly wins being usually in the 13% range, although during this type of market that we're experiencing now, our wins tend to be a little bit higher than that. Now this strategy can be entered in one of two ways. As we said before, we can either attempt to adapt to the market by varying our entry date based on implied volatility, as we do demonstrate in the V32 program, or we can simply start the trade 30 days to expiration, as we do in our weekly options trading for income webinars, which are available with our Go Level membership. Today, we're simply going to enter the trade 30 days to expiration, mainly because the trade is easiest to demonstrate this way, and in this environment, we're entering them 30 days to expiration anyway. So let's take a look at the trade here. Let me go to, this is our June trade, by the way, and it's going to be closed because we're 30 days to expiration for July. So let me actually just go to the July trade. So this is going to be our entry position for a V32. If you're not familiar with this software is called OptionNet Explorer. We have the options that are available on the Russell 2000s up here is shown. The price of the Russell 2000 as of Wednesday, June 17th is $1427.44. And this here demonstrates that we're currently 30 days to expiration for our July 17th, 2020 expiration options. The strike prices of our options are along the left side here. If you come down here, you can see that we entered or we sold 20 1410s. We bought 10 1450s. We bought 10 1350s. Now this is going to be a 10 lot position. Now in a 10 lot position, we're going to have to multiply our loss numbers and so forth by 10. So this trade is going to have a $2,500 maximum loss, and the planned capital for this strategy is going to be $35,000. In other words, we're not going to let this go over $35,000. And this is going to be our entry position. For those of you who aren't familiar with an analytical graph, the asset price is along the bottom. So you can see we're at 1427. This is the asset price right here. The sharp-edged line or the triangle-looking line here is our expiration line, or what the position value would be at expiration. Should we let it go to expiration and not do anything? The thinner curved line here that goes from red to blue to green is going to be what we call the T plus 0 line on the position. Now, this strategy, when it's entered, is going to look differently depending on the implied volatility skew in the marketplace. Right now, we have a very high implied volatility. Therefore, what happens is our expiration line is actually above 0 here to the upside, and our entry delta is 27.72. Now, this strategy is always entered positive delta, and it's always kept positive delta for the duration of the trade. It is a slightly bullish strategy, but it tends to work well even when the markets go down, and as long as it's not overwhelmingly fast to the downside. So currently we're sitting in this, and our maximum capital in the trade is, here's 15,000 here, so a little below the 15,000 line, so probably around 17,000 capital in this. We have the potential to make $40,000 if we expired on this day and we didn't do anything, which isn't going to happen. And then if we go up, the most we could lose if we did nothing, or most we could win if we did nothing in this case, is going to be a little less than $5,000. But you'll see there are adjustments. So with this strategy, what's going to happen, if it gets negative delta, we're going to make an upside adjustment. If it gets below the short strikes here initially, we're going to make a downside adjustment. Once we start adjusting it up, the downside adjustments come a little bit faster. So we have different downside adjustment points depending on what the positioning of our front wing is. And then as we shorten our front wing, we're also going to shorten our back wing if our capital gets too high to keep it under control of under 35,000. Like I said, we have no ways near 35,000 in this now. So we're positive 27 delta, and just for people who are newer, that essentially means that in this position, it's predicted to gain $27.72 if the market goes up $1, and it's projected to lose $27.72 if the market goes down $1, and that is for the first dollar. Every dollar this shifts, your delta is going to shift a little bit. So let's move forward and let's see what happens here. So as time goes by, what is going to happen is the expiration line tends to go towards the T plus 0 line, tends to go towards the expiration line, and generally we're going to make money. So let's go a couple days. You kind of see day to day how the position reacts. Everything's going well here on the 23rd. 24th, we end up getting a substantial down move. So at this point here, when we have a 40-point front wing, we're going to roll this back and essentially emulate or go back into starting position when we get the trigger to roll this back. And like I said, with a 40-point wing, that's going to be at the short strikes. It's time for that, and we're essentially going to reposition back to normal. So let me shut this off. And you can see we roll back to what we call starting position, where the short strikes are, we call it 17 to 27 points behind the money. And in this case here, we still have a 60-40 wing. That still works. And that is our position after the rollback. So we went from here to here. Okay, let's go forward. And this is a common thing that happens, right? We got a big down move in the market, and now it is spinning the other way. A little back and forth action. And boom, we take off to the upside. Now the position as of the 1st of July is up $4,000. During the whole time, our delta here has been positive. So let's continue on. Then on the 2nd, you see our delta goes negative. So this position here does not allow negative delta. So to correct the delta, we are simply going to do a vertical spread and roll in this upper long strike like this. Now, if we get to the point where this wing gets a certain width, then we're going to start rolling up or moving these long strikes to take capital out of the position. And also, because I did the rollback, because I changed the location of this option here and I shortened this wing a little bit, that does change the point at which this position gets adjusted to the downside and rolled back. So let's just let this go. Go to the next adjustment. Nothing to do here. We're still above our rollback point. Okay, so now we're July 10th. We're up $6,700. We're 7 days to expiration, by the way. We have to make an upside adjustment because we went to negative delta. So this is the position that we were in. You can see our delta is negative. When we roll this back, our rules are telling us or requiring us to roll or bring these 1310s to 1320. So we're going to do that, and so we're going to end up doing, you'll see where the ending position is. We end up rolling this back, rolling this up, and now we're slightly positive delta, so we're good to go. Notice we still only have 15,000 in the trade. Pull back a little bit, not a big deal. This day here, we are solidly negative delta again. We're going to do the rollback, and we're also required to roll in our 1320s to 1330. So we're just going to do a condor order here and come into something like this. Again, notice we're only about $12,000 into the trade. And now we're 2 days to expiration. Once again, we are negative delta here. So we're going to roll back these, and I believe I did these two. I'm not sure. Let me see. Yep. So we rolled these from the 1390 to the 1380. These ones from the 1330 to the 1340. We have 12,000 in the trade still. We're slightly positive delta, and we only have one more day in the trade. So if we go to Thursday, let me ignore trades here. It's going to expire Friday morning or the following morning. So realistically, we are, well, 110 points from going negative P&L if this expires the next day. So I would be comfortable expiring this. In the software, we're going to trade out of it. So we trade out of this at about a $7,900 profit. It's going to be slightly under $7,900 after our execution numbers. Actually, let's take a look at some of these numbers, and they're quite impressive, right? So we had a planned capital of $35,000. I think we had under 20,000 in the whole trade. So if you go and you run those numbers, the percentage is very, very high on return for the trade with actual capital, and it's pretty high even with our planned capital. I think it was in the 20% range. So an excellent trade for July. Now the question comes in sometimes when we show a good trade or a trade that produces a high profit, how has it done for the year? Because an individual trade, you can always show a good trade that's individual, right? So let's just take a look at our options trading for income results for the V32. Now on Monday mornings, what we do is we track 12 different option strategies, and then we record the results for them. So this is how the V32 has done this year thus far as of the July expiration. August, by the way, is doing very well as well. So in January, we had a 6% return. Very good. February is where we started having problems in the market. We had that big market crash. So we had a loss of 2.3% in February. We had a loss of 12.1% in March, and the very large market drop. Some would call it a market crash. It's the largest point move we ever had. Not worried about that, right? This is a bit of a bullish bias strategy, and for that type of environment, we had a fantastic showing for the trade. Now, once things started to turn around, April, we pull a 17.5% gain. wiping out all the losses from the previous 2 months. May a 15.5% gain, June a 10.7% gain, and July a 22.5% gain, all on our planned capital numbers. For the year, as of the close of July, we are up 57.72%, which is absolutely phenomenal for a very simple, slightly bullish strategy in the crazy market we've had this year in 2020. So, and that is the V32, this month's winning trade. If you like what you see here, I encourage you to join us and discover how you too can follow along with this and many other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about upcoming winning trade presentations, and perhaps best of all, you can get information about our free Trading Performance podcast, where you can learn to become a much better and much more effective trader regardless of the type of trading you do. If you have any questions or comments you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below and we can get those questions answered for you. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic information on how to profit through income trading. Thank you, and we'll see you on the next Winning Trade.